Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Over the past several, really month or a couple months, we've been getting a lot of inquiries from journalists around news articles related to bonds. And we've been quoted in a couple of these different articles. And we realized that it seems that bonds are becoming more interesting to people again. And so we want to delve into giving you actually a series around bond related issues. What we'd like to do is we're going to provide you with several videos. And in January, we're going to have some in-person meetings that we're going to invite you to, where we're going to continue our conversations around bonds, because bonds are a very broad topic and it can go very deep. And so each session, we're going to talk about a piece of it. We've done a couple of videos in the past, but today we want to talk about some of the bond mistakes. There was a recent article that I was quoted in where it talks about some of these mistakes. And so we want to address them. The 7 mistakes that we want to talk about today are assuming bonds are an adequate diversifier by itself, selling trading bonds instead of holding them to maturity, holding bond funds instead of individual bonds, chasing yields, not understanding how callable bonds work, not realizing that some bonds change over time, and not considering taxes. And so let's start, Steve, with just talking about bonds as inadequate market diversifiers. We actually did a whole video on this recently, but maybe we should summarize that.
Well, the thing about bonds as a diversifier is that it really depends first on the type of bond you're looking or considering buying. For example, corporate bonds actually may become correlated, which means their prices can move in conjunction with the stock of the company that issued them when there is
same underlying risk, right?
That's it. Yeah. And the problem with that is you may experience at that point some of the risk of the company without any of the upside. The only upside you have with a bond is literally the coupon. That's it. Whereas at least with the company stock, well, you may take a 20% or 30% loss on paper, but if it's a solid company, they're going to recover. And look, your long-term prospects are very good, most likely. But with the bonds, what are you going to get? You're going to get the $1,000 you invested in the bonds, and the 4 or 5% annual coupon. And by the way, also to mention why bonds are of such interest now, for the first time in 4 years, or probably actually in 12 years, 10 years, bonds are actually providing yield. They weren't for years, literally years.
Right. So, but that didn't mean that they weren't still a good part of somebody's portfolio, and somebody should have considered keeping them.
Yes.
The other thing, though, that I'd like to say about bonds as a diversifier is I want to make sure that people understand we're not saying that it's not a good diversifier. It can be. However, the one thing that we have said, and we showed a study in our last video where we saw over the past 100 years, bonds were sometimes positively correlated with the stock market and sometimes negatively correlated with the stock market. So sometimes they did provide adequate diversification, but other times they didn't. And so we want everybody to understand that bonds can be a diversifier and should be part of the portfolio, but maybe you don't want to just rely on bonds.
And also the other thing to think about is that the type of bond you buy matters a lot, from the aspect that if you're buying really safe municipals or government agencies, you don't have to buy 40 different bonds to be properly diversified, because the credit default risk is almost non-existent there. But with corporate bonds, you have to have many different bonds from many different companies to be adequately diversified. And to do it efficiently, you need like $10,000, $15,000 positions in each, which says right off the bat you're going to have a couple $100,000 at least just to put in the corporates.
So let's talk about our second mistake: selling trading bonds. If you tend to sell a bond on the secondary market before it matures, its value changes based on interest rates. And so maybe that, you might not want to do that, because that's where competition really comes into play. I guess the question is, when interest rates do change, should you sell the bond? If you're holding an individual bond, you can hold it to maturity, which actually brings us to the third mistake, and that's holding bond funds instead of individual bonds.
Right. And the problem with bond funds, first of all, you do have the management fee. And I saw one recently. It was a municipal bond fund that has a management fee of about 50 basis points. So right there, you have that impacting your yield. Additionally, they're constantly trading bonds behind the scenes. And also when we saw the increase in interest rates and there were a lot of redemptions in these funds, guess which bonds the fund manager sells? The ones that probably have maintained the best, pricing, which means you may end up in a portfolio with lower quality bonds without even realizing it.
Right. So can we back up, Steve, for a minute? What you just said is really important. And I just want to add some flavor to that. Bonds have this very discrete maturity dates. When you hold an individual bond, you know that you can hold it to maturity and get all of your money back. However, when you're in a bond fund, there is no maturity date. The bond fund is a pool of a lot of different bonds at different maturities, and it's just a rolling pool that a fund manager is maintaining. So you might say, well, I'm going to hold the bond to maturity, but guess what? The people that you're in this bond fund with, because there are other people that are coming in and leaving, they might not have the same feeling. And so when people come and they start withdrawing their money, and that usually happens when there's a hiccup, when things aren't going that well, they'll start cashing out their money. The bond fund manager is forced to redeem whether they want to or not. And that can be very difficult, as Steve just mentioned, because the bond fund manager is going to sell the quality bonds, and the people that remain and stay in that bond fund are going to be left with substandard quality bonds. And we've seen this numerous times. It is definitely a problem that has presented itself, especially at the worst of times.
There was also a Morningstar study I read a few years ago, and they looked at a number of different bond funds, and the fund managers were not really doing what they claimed to do. For example, there were some bond funds that called themselves quality bond funds, and they were holding BBB and below, which are junk bonds. So they weren't entirely honest about what their holdings were. And so that's another issue when you buy a bond fund. You really don't totally know what the bond fund manager is actually doing.
Right. Now, individual bonds, you have a lot more control.
Yes.
So another problem, another mistake, a big mistake people make, chasing yields. And that really the problem stems from the fact that people are not defining what the role is of the bonds. If in fact you're expecting your bonds to be a stable asset class, maybe you don't want to use bonds that are fluctuating all over the place, and maybe they're not the place where you want to put risk. However, a lot of people buy high yield bonds, or what a lot of folks call junk bonds, which are distressed companies. And we know these bonds default. They have high default rates.
Junk bonds have had default rates ranging from 5 to 10%. I've seen. There's always that famous expression, which I've said and repeated in other videos, there's no such thing as a free lunch. And if you see a 7 or 8% yield on a bond, when yields in general are closer to 4 or 5, there's a reason for that. There's always a reason. Don't expect somehow you're getting a gift from the markets. You're never getting a gift.
Well, so Steve, you and I have talked about it, and we've always said, if we really want to chase yields, why would we just go into the equity already? If we think that it just doesn't make any sense to us why people would use junk bonds or high yield bonds.
That's correct.
Another problem, not understanding callable bonds. And, even if you go to a custodian and you look up bonds, you'll see the highest rating, the highest yielding bonds will tend to always be callable. But I wonder how many people even notice that, Steve. Yes, the little notation that it's callable.
Yeah, and there's a lot of issues with that. Call features almost never work to benefit the bondholder. They always work to benefit the issuer of the bond. So as an example, if you buy a bond for argument's sake, it's a premium bond, which means it's selling for above par because it has a very high coupon. Argument's sake, for $110, you paid $110 for a $100 bond, and they're always quoted that way, usually in hundreds of dollars rather than thousands, because you're really spending $1,100 for a $1,000 bond. Anyway, you pay $110 for a $100 par bond, but it's callable at 105. So you think you're getting a really high yield, because what's happening is you're you're going to be able to get a really high yield on that bond. But what happens is it could be callable at 105 and it could be callable in 2 years. So the bond's value could only really at that point be 107, but it's callable at 105. So guess what? You're losing $2 when that bond is called on the call. And additionally, now you're faced with reinvestment risk, because why would they call that bond? The reason they're going to call that bond, the entity, is because they're able to refinance that debt at a much lower interest rate. And so why are they going to keep a bond that may have a 7% coupon on it when they can now reinvest that, I should say, refinance that money at a 5% coupon? So that's what they're going to do. And so guess what now? Now you're faced with what's called reinvestment risk. Besides losing $2 on the value of the bonds, now you have $105 that you're going to have to reinvest at probably a much lower interest rate. So now you have reinvestment risk.
So the question is, are you able to lock in a rate? If you think the rates are at the higher level that they're going to be, maybe you want to lock into that instead of having a callable bond where it might change. And one thing that, if you insisted on looking at callable bonds, you should look at is not just the yield to maturity, but the yield to call, because that comes into play.
And you can also maybe play out some different scenarios for reinvestment risk too. And say to yourself, well, gee, but it does get called, what happens if interest rates are only 5% then? How will my yield to maturity be? Versus if I just bought a non-callable bond that has maybe 1 or 2% less in yield currently, but it's not callable. But you know that you have a good solid 20 years of that return. Demonstrated is that people think that bonds are simple. They are not necessarily simple.
No, they're not. There's also liquidity risk, because callable bonds can sometimes have lower liquidity as well. So that becomes a problem. If you actually do want to trade or sell that bond, you could wind up giving up. So there's a lot of problems around callable bonds that people really need to understand what they are. And I see people that don't know what they're doing, buying callable bonds without even realizing they bought callable bonds. Another mistake that we have listed here is that some bond yields change over time, particularly the ones that are impacted by inflation. So tips, I bonds, those types of things. I bonds currently are sitting at a 5.27% return for the November to next April 2025. It's significantly less than what it was a year or two ago. And some people bought these bonds at these higher rates, thinking that they were going to get those higher rates for a long period of time. And now they're locked into those bonds because you have to stay in them for at least a year. You're not allowed to sell them. And then, yes, you can sell them between the 1 year and 5 year mark, but you will get hit with a penalty of the past 3 months interest. So these rates are in these different vehicles are changing over time, and you need to understand that.
We're going to wait until the government fools people a little bit by kind of making a complex promise that confuses people, and they don't really realize what they're buying sometimes, which is kind of sad.
Well, it is sad. I don't know if they purposely do it or they just don't take the time to fully explain it to people.
Yeah, that could be.
The last mistake that I have listed here is that some people don't consider tax implications, and different types of bonds have varying tax implications, and it's important to understand corporate bonds versus all levels of even government bonds, whether it's federal bonds or municipal bonds. They have different tax situations, federal and state, that can be more favorable to you in one situation versus another. And it's important to understand that.
There's actually even taxable municipal bonds, which sometimes it can make sense to purchase those in an IRA, taxable munis.
Yep.
So you got to, your Laura's right, you have to look at all the different tax implications of bonds. And there's also something called original issue discount, and which we're not going to talk about here.
But I oftentimes, it's that's one area, Steve, that I don't think we talk enough about. A lot of people that we have, their taxable money in municipal bonds, because we've done a tax equivalent yields calculation where they're getting a favorable benefit on their tax return And it might look like they have a lower yield, but when we factor into the tax savings that we've achieved for them, net, they're much better off than if they went out and bought a treasury that is 100% taxed at ordinary income tax levels.
Yep. And by the way, if you're concerned about taxation of Social Security, interestingly enough, when they consider how much of your Social Security should be taxable, they factor in your tax-free yield on municipal bonds too. So it's just an interesting thing to be aware of.
So in summary, individual investors must grasp the significance of bonds in their portfolio and maintain a disciplined strategy within their allocation. So in order to do that, you really need to understand what the bonds are doing and what you want them to be doing in your portfolio. Most clients understand the basics around bonds, that they have an inverse relationship between yields and price and some basic things, but it really does go fairly deep. And so what we'd like you to do is to watch for our other videos that will be coming out over the next couple of weeks, where we'll continue to talk about bonds and hopefully start clearing up some of the questions that you might have. But if in the meantime you have some questions that you want cleared up, please email us and we're happy to explain it to you either just one-on-one, or maybe we'll do another specific video on that particular topic. And by all means, mark your calendars and save the date. We have 2 in-person events that we want to invite you to, where we're going to be inviting somebody from the bond industry who does trading bonds all day long. The first event is going to be on January 4th from 5:30 to 8:30 at the Laurel Oaks Country Club in Sarasota, Florida. And the second event is actually going to be on January 24th from 6 to 8 at the Patterson University Library Auditorium. And that's going to be later in the month. But both events, we are inviting primarily our clients. They are client events. But if you happen to be listening to this video and you're not a client and you're interested in learning more about bonds, we're not serving a steak dinner. We have nothing to sell. We just want to provide education and continue to build relationships. So you're invited. Please RSVP, however, if you are interested in coming, so we make sure that we have the space and we've planned for your coming.
And the only guarantee you have is that you will learn something.
Absolutely. So thank you for listening to us, and we'll talk to you soon.